Hey, good morning, everybody. Thank you for joining us today on this Tuesday, October 18th for Small Business Boot Camp. I'm Robert Theobald, Small Business Ombudsman and Vice President of Small Business Services at the Arizona Commerce Authority, and I'm glad to be with you here today. We've got a great session planned, but before we jump into that, I want to go through what we normally start out with, which is thanking all of our community partners. We could not do these community partners without their time, their effort, and their expertise. This is just a sample of the nearly 200 community partners that have helped with the boot camps over the last 2.5 years. So those not familiar with the Small Business Boot Camp, if this is your first time participating, the Small Business Boot Camp is designed to help small businesses as they look to prepare, plan, and grow their business. Sorry about that. It is a statewide initiative supported by all of our community partners. And not only is it our webinar that we do every Tuesday morning at 9 a.m., it is a content library and a series of workshops. And we'll touch on each of these here before we get started. So first, let's talk about the content library. We have been recording all of the bootcamp sessions since the very beginning, and we make these available to you on our website in the content library. There's over 200 plus webinars and presentations that are recorded, and it includes the recording, and most often there's a handful that don't, but most of them include the slide deck of the presenter, so you can download that as well. And sometimes there's additional materials that the presenters may have provided to be included. So it's a great resource. As you see on the screen, you can also sort the content library by various different categories to help narrow down the information you're looking for to best to get the learning that you need. So that's a great tool. Another great tool that we have a number of great tools at the Arizona Commerce Authority. Our small business services, our workforce division, and our Arizona MEP are both all divisions that can help support your small business depending on what your needs are. And so reach out to us if you have any of needs in those areas, and we can guide you to those resources. Another great resource that we have is the Small Business Checklist. This is an online interactive tool to help small businesses that are getting started or looking to grow and expand to identify the commonly requested licensing, registration, and compliance needs at the local, state, and federal level. So for example, if you're looking to expand into another city that you haven't been working in before, you can look up that city and see what requirements that city may have regarding licensing and operating in their community. Or if you're looking at starting a business, you can do the same. You can look at the city, look at the industry, profession, and so forth, and identify who you need to contact to get started and get going. So it is a great tool. So real quick, we want to touch on some of the upcoming sessions. So we have today's sessions on getting business capital, preparing, adapting, overcoming. And then next Tuesday, we have Instagram Marketing Challenge, Tips for Success. We don't have it listed on here, but the November 1st session will also be a social media and marketing session. We are finalizing that content with our presenter, but we'll have the information on that up shortly. And it should be a really good session as well. And then on Wednesday, November 2nd, we have one of our workshops that I mentioned earlier. It's Grow Your Business, Access to Capital and Other Business Resources. This is the fourth in a series of 4 that we've done in partnership with the Phoenix Business Journal, Wells Fargo, Gallagher and Kennedy, the accounting firm of REDW and Blue Cross Blue Shield, as well as the small business development centers across the state. And with that, this one's going to focus a little bit more on the ending the year and the things you need to look at as you end the year in order to maximize the potential for getting the funding you may need for growth in 2023. So we're really excited about that. So it's a both in-person and virtual. In person, it'll be down at our offices in Phoenix. And if you're not sure if you want to come, there's plenty of parking that's no cost on site. So it's easy to find, easy to park. And so please join us there. With that, we're going to jump into today's session. We have Craig Jordan from the Small Business Administration, Arizona District Office. I'm excited to have Craig with us. Craig works with all the lenders around the area, around the state, around the district to help them with their understanding the SBA programs and loans and so forth. And he's a great resource. So I'm going to go ahead and stop sharing and turn it over to Craig. I will apologize. I may have to jump off early, but Faith will wrap us up. If I do, I am out in Gold Canyon at the moment, preparing for a Gold Canyon Chamber of Commerce meeting I will be speaking at as well. So Craig, with that, I'm going to go ahead and turn the time over to you. And as Craig is getting his screen up, if you have questions, and I'm sure we'll have some questions, please post those in the Q&A box found at the bottom of your screen. We like to post the questions there, so when we have interaction in the chat, we don't lose those great questions in amongst that chat interaction. So with that, it is all Craig's.
Well, thank you, Robert, and thank you, Faith, for putting this together. And want to thank the Arizona Commerce Authority for your continued collaborative relationship, with our office and for doing stuff like this, because it's really important to get information out timely to the small business community. And this is one of the things. So we're going to talk about the lending landscape. We're going to talk about the process that's involved. We titled the presentation today, Prepare, Adapt, and Overcome. And we're going to address those three generic topics as we go through here. But the main idea of today is to give you a really good idea of what your options are going to be when you go to try to get a commercial loan. Also, what your resources may be to help you overcome some of the more technical aspects or issues that you may run into when you're engaging a lender, as well as kind of outline for you a little bit of the landscape, what kinds of lenders are out there. So the idea of today is just to take a little bit of the headache away from this lending process to make it a little bit easier for you to get that money, get that capital to help your business start or grow. And I always like to start by saying there's really three things I'd like for you to get out of today. One of them is to know what SBA is and does if you don't already. We're a very aligned organization with Arizona Commerce Authority. There's a lot of things that we do that are very similar. The second thing is you should have a real good idea how strong or weak your credit profile is when you're going to be approaching a lending entity. And that is probably the most important. The third thing is you really should know what the next step is going to be for you. You may be prepared after this conversation. You may decide I have everything ready to go. You may decide that you want to do a little bit more research. You want to shore up a few things that you can from a credit perspective, or you want to go get neutral third-party advice. Those are the three main things that I'd like for you to get out of today. And by preparing, you're already preparing by being here. Adapting, we'll talk a little bit about that as I kind of pitch to you the kinds of obstacles that are typical, and then overcoming are, your reaction to those obstacles. But to start by giving you an idea what SBA is and does, we're a federal agency. We were created in 1953 to promote small business in our domestic economy. Our mission statement is to aid, counsel, assist, and protect insofar as possible the interests of small business concerns. And I know that's a very generic statement. So just to give you an idea of how that works. On a local level in Arizona, we cover the state of Arizona, and there are three main things that we do out of our office that are direct to the public or to the small business borrowing community. We have an arm of business development and counseling. This is an area where we partially fund several organizations to provide one-on-one counseling to you. And Robert had actually touched on a couple of those in the slide and also in his discussion of the upcoming sessions. We have a bunch of different organizations: Small Business Development Center, Veterans Business Outreach, SCORE, and I'll talk about those a little bit later. But what their job to do is to help the small business community in everything that they could need from A to Z. We'll go over that in a little bit more detail. Financial assistance, the second bullet point, that's really where I work. And to give you an idea of what I do, I basically train and assist the lenders that participate in our program. So it's my job to essentially be a liaison between the lending community and the agency, our policies and procedures that they need to follow in order to keep that loan guarantee from cradle to grave. For those of you that don't know how the loan program works, it works a lot like other government guaranteed programs. Lenders would sign up with us, and when they do, they have to follow our rules. If they do follow our rules, they will have either a 50 to 90% guarantee, depending upon the loan size and the loan program, of their loan as long as they hold that loan from cradle to grave. And what that really does for the taxpayer, is it makes it a little bit easier for you to get the loan in the first place, because the government is guaranteeing that loan if it were to go bad. It allows them to take more risk. So it allows the lender to lend to more borrowers. It allows the taxpayer to potentially get assistance where they wouldn't be able to without any other means. The third thing that we do locally in the district is procurement assistance. And what that basically means is helping you identify whether your product or service could be purchased by the federal government. And then based on your business demographics, what programs you may be able to certify yourself as that can provide you some avenues for potentially lower barriers to entry of contracting with the federal government. So on the first Wednesday of every month, our local office does seminars. And what we do is try to introduce you to the financial assistance side of the Small Business Administration and the procurement side of the Small Business Administration. We call that program called Selling to the Federal Government. And for the financial part, we simply call it the Loan Clinic. And if you go to sba.gov/AZ, you're welcome to peruse there. You scroll down a little bit and you'll find a calendar. And on that calendar, it'll show you when the next presentations are. Now, the other two things that SBA does that are a little bit outside the scope of the district is advocacy and disaster assistance. Advocacy is essentially attorneys on Capitol Hill looking at legislation, trying to make sure that it's passed in the best interest of small business. Disaster assistance, many of you are familiar probably with the recent pandemic and those COVID-19 economic injury disaster loans. Those are done out of a different division of the Small Business Administration, but those are some of the things that we do within the scope of our agency's directive. So that's what SBA is and does. But we're going to talk about capital. And when we talk about capital, I want you to think creatively about what it is that you're trying to finance and think about where you may be able to have options to get that capital. When I talk about these different resources, we're going to first talk about how you prepare for getting a loan. Then we're going to go and drill down to actually how an SBA loan works. But when you're talking about where you get the money from, obviously your own money, your retirement insurance, that's the easiest place because you don't have to ask anybody's permission. But you also want to be careful because once you take money out of some of these accounts, you can't put it back. So you need to understand what the ramifications are. They can create tax liabilities for you, penalties, so on and so forth. Borrowing from friends and relatives, we always mention, be careful, get a signed note in terms of repayment, have them sign a gift letter if they don't expect it to be repaid, because any bank, when they're evaluating your credit scenario that sees you have a large amount of funds that didn't come from you, they're going to want some sort of explanation. And that's what a gift letter and a signed note in terms of repayment can shore up for you. And then in terms of banks, credit unions, and non-bank lenders, that's really where the SBA loan program is. We focus on federally regulated lenders. So all the retail lenders that you see, most of them are already going to be SBA lenders and they're already participating in our loan program. They do have varying credit appetites, and we'll talk about that as we go through. In other words, some of them are more active than others. Some of them have more of a skill set or knowledge institutionally than others, and things of that nature. So you do have to shop the lending community to find the right lender for your circumstance. And as we're talking about that project, right, what you're financing and breaking it down to everything that's different that you're financing, we're talking about other potential uses. Maybe advertising, looking in a trade publication for investors or advertising, your business, credit cards. The thing there with credit cards is you want to try to make sure that you segregate the credit expenses on a credit card so that you don't have intermingling personal expenses with your business expenses. Because if you ever want to try to refinance a credit card balance with a commercial loan for your business, you're going to need to prove it was for business purchases only. We talked a little bit about life insurance already. Money brokers. So these could be physical brokers. They could be online brokers, you see the commercials, Lending Tree and things like that. They're essentially paid to market for lenders. So they end up taking your information and pitching it out to a bunch of lenders that have signed up. So you do want to be careful with that, especially when you're providing your credit information. SBA has a version of one of these. It is inside sba.gov. It is called Lender Match. If you were just to go to sba.gov, type into the search box, Lender Match, it will take you there, and it essentially will ask you questions about your business and then it will pitch your information to only SBA lenders that are participating in the program. So that's one way you can find lenders. And then I'll talk to you at the end a little bit more directly about how to find a lender on your own, which I recommend using both. But then other options are crowdfunding, merchant credit, non-regulated lending, and angels. And for those of you that maybe aren't as familiar with these kind of alternative options, crowdfunding, essentially could be debt, it could be equity, and it could be a gift. It just depends on the website and what the parameters for that website are. And I'm going to talk to you about enter into any lending agreement. Make sure you understand the lending agreement. Make sure you understand what your obligations are, what your repayment terms are, what the note rate is, what the structure of the term is. But what we're talking about here is making sure that you're just kind of kicking over each rock. Merchant credit is kind of like bootstrapping. It's like saying, hey, if I can get credit with a merchant, maybe I can get 60-day terms on some equipment or some inventory that I need, and I can turn that over into cash before I need to pay it, then you may not need to have that particular piece of money inside your loan, because your merchant credit is going to allow you to be able to utilize those funds for that equipment or that inventory. Non-regulated lending, these are more or less, lenders that you wouldn't find in the federal, landscape. Angels are going to be things like more specialized, kind of like the Shark Tank is, but a little bit usually more specialized. Usually the angel groups are very considerate of a specific industry that they're familiar with. And then we'll touch, a little bit on equity. We don't work on the equity side, but we do have equity partners. We have a program that we partner with equity groups. And equity can be a good option like angels, especially if you have something that you see as a business that could skyrocket, and then you have an exit strategy. So something, that would be very attractive to investor would be like a technology that, that could grow like crazy. It's not the right fit for an heirloom business, something that you want to start, grow organically, and then pass down to your, to your family. But equity is also another option that can, potentially provide part of any kind of project that you're looking at, depending upon your business model. So it's just to think creatively about where to get business capital. And when we talk about asset-based lending, this is or hard money. What we're really talking about is things that aren't underwritten like a regular commercial loan. And the reason that they aren't is because they're going to take the asset that they feel strongly about, and they're going to give you money. They're going to lend you money based on the value of that asset. So not that it's the best way to go. Typically, these have higher interest rates and some other catches that you need to be aware of. But the reason why I want to mention it is because if you have a credit history that has really recent problems, you may need to look at other forms of lending that are a little bit more aggressive, and you need to be careful, because most of the commercial lenders are going to want you to have decent credit. They're going to want you to have a repayment history. Whereas asset-based lending, you don't have to have great credit. You don't even have to have a job. You may not even need to show any ability to repay. They're all kind of structured a little bit differently, but I wanted to let you know, if your credit is in the tanks and you don't really have any other options, you're starting a business, but the business has an awesome, trajectory, that it could be possible for you to get financing this way. Now, when we talk about borrowing money, we're talking about the standard, format. We're talking about regular underwriting, and we're talking about, going to a bank or going to a lender. From an SBA perspective, there's no such thing as 100% startup financing. You do need to have a down payment or skin in the game, and we'll talk about that. There are also no current SBA grants to help you start a for-profit small business. There may be grants out there. And for the federal landscape, that is housed on grants.gov. Other grants are usually situational. Most other grants are some that I've seen are some sort of pitch competition, where you have to pitch your business plan in order to get a grant to get that business started. Or you have an innovative technology that you have to show has, like solves a problem. That's possible. I've also seen people who are aligned with like nonprofit organizations. For example, like battered women or, single mothers, things of that nature, that I've seen also do grants for helping somebody start a for-profit small business, but the SBA doesn't have them. And to find them, it's a very difficult challenge, and you would need to reach out to the community, reach out to the, to the areas that you would touch in the community, and do some research on your own. Your credit history is going to be very important. We're actually going to talk about that. The other thing to know is that a lender is going to require a personal guarantee from you and potentially your spouse. They may even require a secured personal guarantee. Now, I'll explain what that means. A lot of people don't quite understand what a secured personal guarantee is versus a personal guarantee. Basically, a personal guarantee is you signing that you will repay the loan and your credit's on the line. A secured personal guarantee is you have an asset that they're going to lien in addition to that in order to get it repaid. So secured means that it's actually got the capability to have a lien placed on it. But let's talk a little bit about item number 2. You should have a real good idea what SBA is and does. We're going to talk now about the most important part of what we talk about today. This is where your ears need to perk up and you need to start thinking about your situation, because I'm going to explain these credit factors. Sometimes they're called the 5 C's. I don't like using the 5 C's because when you read the 5 C's, they don't actually equal, street sense. So I like to use equity investment, which is your down payment, your repayment ability, okay, which is how are you going to repay that loan, your working capital, which is what's set aside, what's the emergency reserves, your collateral position, which we just talked about, that secured personal guarantee. Do you have anything that could shore up, the loan from risk, your resource or management ability, and your credit history. So these are the things that you're going to want to find out whether you have strengths or weaknesses in. And hopefully many of you have seen your credit score in the last 90 days. But it's the first thing they're going to do. As soon as you give them authorization to do it, they're going to pull your personal credit because they want to see how you've managed it. All right. It is the gatekeeper. And so the question is, what about do you need to have? And as you can see there, the 680 score, to give you an idea, is around A- or B+ credit. SBA doesn't have a minimum credit score that we require. We allow the lender to make that decision. What I wanted to show you by this score is if you're 680 or above, you're probably okay with 90% of the lenders that participate in the SBA loan guarantee program. The real question is what happens when you're lower than that, right? So when you're down to 660, 640, you get all the way down to 620, and that is about where the bottom tier of commercial lending exists. When you are below 620 or just above 620, you're probably going to have an explanation as to why your score is that low, because that's considered like B- or C+ credit. And so it's important that you know what your score is. It's important that you have a story if you are below 680 or if you have recent blemishes on your credit score. Sometimes lenders can make exceptions. They can look at your credit and see, that there have been issues, but maybe they weren't caused by you because you went through a medical procedure or, a divorce or something along those lines. When you have a good explanation, they may be able to work with you. But the important thing is know what your score is and have a pretty good idea where the low end and the high end of that range is. Obviously, if you have an 800 credit score, then you have a strength, and you can leverage that strength and actually leverage against weaknesses that may be present in other areas of your credit profile. So hopefully you all kind of understand credit, and it is the gatekeeper. And this pie chart just shows you kind of the grading of it and about how they use the algorithm. 30% on amounts owed, 35% payment history. And once you get to be that 660 and above, 680 and above, it's considered good. And again, you'll get this slide deck so you don't have to memorize those. Now we'll move on to equity investment. And what we're talking about here is down payment, right? SBA does have a minimum down payment for buying a business and for starting a business. You have to have a minimum of 10% of your own funds. So this chart here is really just showing you how the math works. And I chose to use 30% as an example, but if you use 10%, you could just apply the math. The scenario here is a $300,000 loan with a 30% injection. Obviously, the 10% injection would mean you would need to show 10%, which is 30,000, and then the bank would lend you 270. In this scenario, I just wanted you to understand how the math works, and I ran the scenario of a 30% injection. So your total project is 300,000. The bank is going to lend you 210, and the bank expects you to have accessible injection of 30% or 90,000. Okay. And this is just to show you how this works. They want you to have what we call skin in the game. It doesn't have to be cash that you have sitting on the side. It can actually be cash you have sitting on the side, or it can be things you've purchased to run the business. Normally, they need to be purchased if you have receipts within 12 months, but your bank can be flexible on that. So if you're a landscaper and you've been planning on running your own business, but you've been working for somebody else, so you've been buying equipment as time went on over the last 3 to 5 years, it's possible for the lender to accept it depending upon the condition of that equipment. But you need to be able to account for it. So you need receipts, and it needs to be pretty obvious that that particular equipment was used to get your business off the ground, and then they can count it as equity in your business. This scenario on the right is just to give you an idea where there's higher risk, higher fees, and more limitations. And what this would be is a riskier business where the bank would potentially ask you to have a larger injection. And the one that I always kind of pick on, because most of you are probably very familiar with, the fact that there's risk inherent in startup restaurants. And so lots of banks will actually refrain from even participating in that industry. But the banks that do participate usually want a little bit higher of an injection. They want you to take a little bit more risk. And in that scenario, I just wanted to show you the 50-50 split, right? The bank is going to lend you 150 and you come up with 150. That does not mean that's your scenario. This can be negotiable with the lender as long as the minimums are met. I just wanted you to understand that if you are at the minimum of injection, in other words, let's use 10% as an example, and that's all you have, that is, and you're starting a business, that is much more risky than if you had 30%, because the bank isn't requiring 30%, but you have 30%, which makes you a much smaller risk than the borrower next to you that only has 10%, because then you're strapped. So equity investment, it's important that you know where you fit. Are you strong? Are you weak? And where are the other strengths and weaknesses so that you can potentially shore up some of your weaknesses with your strengths. Now let's talk about loan repayment. So this is going to be the most important credit factor. All SBA lenders are cash flow lenders. They do not lend on collateral alone. The lenders that lend on collateral alone, we talked about, they're asset-based. So you have to show the ability to repay the loan. So when we talk about that, that's through either your past financial statements and tax returns, or through a business plan with financial projections. Now, what you need to know is that SBA does have a minimum, just like we do with a startup business. The minimum is that for loans less than $350, there has to be $1 of cash flow coming in for every $1 going out as a minimum. For loans that are over $350,000, there has to be $1.15 of cash coming in for every $1 going out. What's important for you to know about this EBITDA and this debt service coverage ratio, which your financial counselors and your financial support can help you run these ratios with your existing history, or if you're doing a business plan. What's important to know about that is those are minimums. Most of the time, the lender is going to want to see $1.25 coming in. So that means $1.25 of income for every $1 going out of debt. Okay. And it's important that you know that, because if you're building a business plan or you're looking at your historical cash flow, you're going to want to see if you're at that or above. So what would be a strength is that you're bringing in $2 of cash for every $1 going out, right? And what would be a weakness is if you're barely making the minimums. So keep that in mind as you're either looking at your history or you are looking at putting together projections for a business plan. And if you haven't done that, that type of endeavor before, that's where you may want to reach out to some of the resource partners that we'll talk about a little bit later, and that Robert had actually put on that slide. Many of them are experts in this area and can help you craft those things so that you have a working knowledge of what is going to happen with those ratios and within your business. So now we're going to move on to working capital. What is working capital? Simply put, it's emergency reserves. It's defined as current assets less liabilities. It's shown on your balance sheet, called the quick ratio sometimes, but it is a critical test done by lenders, and there are different standards depending upon what kind of industry you're in. Obviously, if you're in some sort of catering business, you probably don't need to hold a whole lot of inventory on hand versus if you're a manufacturer. So your working capital need for a catering business is typically less than what you'd need for a manufacturer. But what they're basically looking for is, if you take this loan out, are you going to have any money left over? Is there anything set aside for the ebbs and flows of getting paid by your clients? When you put your dollar out, when does it come back in a sale? Those types of things. And there are publications that you can take a look at where it will tell you what those are. But really what it comes down to is, you don't want to borrow too much, because you don't want to pay for money that you don't need. Sometimes lines of credit are used for this type of working capital scenario. And it's just something you want to be prepared to discuss with your lender. You want to know what your working capital need is for your business, so that you make sure that when you take out that loan, you're leaving yourself with a little cushion. Okay. That's what working capital is. And you're strong if you have tons of it, and you're weak if you have none of it. That's pretty much how you would look at it. Now we move on to collateral, and collateral is generally the most confusing area for people, because what collateral essentially is stuff the business owns and or you own that could be used to protect the loan from loss. And in these scenarios, you will get a UCC1, or you'll get a blanket lien placed on all your business assets when you take out a loan. If those assets are enough to fully cover the loan, they may not ask you for any other collateral that you own personally. But in the real world, most of the time, that's not the case. Most of the time, the business doesn't have enough assets to cover the whole loan. And then they would look at your personal assets, including your home and any other assets that can be liened. The important thing to note here is that collateral is appraised for liquidation value, which the street term is garage sale value. What you can drag it to the street for and get for it quickly, that's what they're going to use for the value of that asset. And so just to give you an idea how that would work, these are some things that businesses typically own, whether it's a personal residence, a commercial property, furniture and fixtures, and about what the garage sale value is. This doesn't cover every type of asset that could be used as collateral. It's not even close, but it just gives you an idea that there is a discounted value for those assets. It's the garage sale value that lenders assign to those assets. And then what they do is they run a ratio of your loan versus the value of those assets, and they find out what your collateral coverage ratio is. And if it's obviously if it's 100%, well, then that's very strong. If you have zero collateral, you don't own anything, you are not buying any collateral with your loan, the next question is could you get a loan? And the simple answer is yes, you could, but you're going to need to have some other strengths in that business profile, in that credit profile, to overcome the fact that you have zero collateral. So maybe there's, extreme cash flow. Maybe there's very, very good credit. Maybe there are other mitigative factors that you can present that would offset the fact that there is no collateral. So with that, we'll move on to management ability. Management ability is actually shown in two ways. One, it's either shown through your past cash management if you have history, meaning you've been operating 1, 2, or 3 years, so you have tax returns, or it's going to be shown in your resume if you're starting up a business. Industry experience may not always be enough. You have to show the ability to manage that small business. And you can potentially obtain outside training to mitigate no experience. And each kind of scenario is unique in and of itself when it's not apparent that that industry experience is there. And the bank gets to make that decision based on their communication with you and what you've shown them your abilities are. And just to give you an idea, obviously, if you've been running the business for 3 years, your past cash management is your experience, okay? That's what they're going to look at. If you are starting a business, and let's say that you were a gardener or something, you're a landscaper, but now you want to start a franchise that sells pet food. Well, you may have some experience, especially if you ran your own business as a landscaper, but it's not exactly the kind of experience that you would need in the pet industry. So they may want to see that you've done some training along those lines to understand the difference between the two. Obviously, if you're selling food or things of that nature, you need to know what the rules and regulations are around that, things of that nature. So you just need to be able to pitch to the lender that you have the management ability to run that business from the moment that it starts. Now, when we talk about tips, one of the things that you've done today is you've shown up, which means that you're you're already going to have a pretty good idea how this process is going to work. So you're already being prepared. Know exactly how much you need it and what it's for. One of the worst answers you can give to the question of how much do you need is how much will you give me? And the reason that that's not a good answer is because that lets the lender know that you didn't actually itemize where all this money is going. It is very important that you do that. So if you need a $100,000 loan, you itemize exactly where all that $100,000 is going. $50,000 for a marketing program and $50,000 for equipment. Knowing your options, we've talked a little bit about what your potential options could be already. Prepare a good loan proposal or business plan. So a loan proposal is one way of putting it for a mature business, where you're basically telling the lender, here's what I want to do, here's the amount of money I need, here's what it's going to go for. Whereas when you're starting, you need to, and you also your historical documents. But your business plan is critical, especially required when you're starting up a business or when you're using projections to expand a business. So it is very important that you're aware that those things will be required when you're not just using the same old cookie cutter business that you've been operating for 3 years. When you're doing something different, you'll need to have a business plan. Proofread what you prepare. You can also get neutral third-party advice from our resource partners that I'll talk about in a little while here, and also provide you with support documents on how you reach out to them. Learn from your mistakes. If you're told no, ask why. Sometimes they'll give you an answer that you can fix and that you can fix rapidly, or that you can explain. Sometimes they're going to give you an answer that you're going to realize this doesn't sound like a good fit. And if that's the case, my advice to you there is look for a new lender, but also ask the lender that you don't feel like you can work with anymore if they know of any other options. A lot of times these lenders, they work in this space and they know what other lenders do. They know how flexible other lenders can be, or where particular industries might fit better, things of that nature. So it always makes sense. If you don't feel like you can continue to work with the lender that you're trying to work with, ask them if they know of any other lenders, and then go ahead and plan on searching for another lender. So we'll move on to SBA loans. What SBA loans are, why are they there? We talked a little bit about that. We talked about the risk. We talked about the guarantee. It works a lot like an insurance product. What happens is the lender handles the loan from cradle to grave. They ask us for a guarantee. They provide documentation that shows this is an eligible type of transaction. And then they have an underlying insurance guarantee of 50 to 90%. But with those rules and with those agreements between the two parties, the administration and also the lender, we do have some what we call legislated benefits. So we can control some of the terms. So we do not allow any balloon payments in any of our loan products. We also cap the interest rates, and we also do not allow typical commercial fees to be charged to borrowers. Again, because we are guaranteeing the loan should it go bad, we're taking and mitigating a lot of the risk away from the lender. So what is the SBA loan guarantee? It is really just a typical commercial loan provided by a participant lender. The general characteristics are longer terms. We do cap the interest rates. And for about every dollar we guarantee, about 1/3 of that, or 30 cents, goes to new small businesses, meaning startups. So we have a lot of loan programs. We have the standard 7A, which we'll call that the umbrella loan program. We have lines of credit underneath that. We have special purpose loans, which would include things like, for specifically exporting, international trade. We have energy conservation and employee stock option programs. We also have microloans, which are not guaranteed, that I'll talk about in a moment. And then we have 504 loans, which are specialized loans that are basically designed for large fixed assets and commercial property. But when we talk about the 7A loan program, you can have a loan up to $5 million. We would be guaranteeing 75% of the loan, or up to 3.75 in most circumstances. The money can be used for most business purposes, and it's generally ideal for smaller businesses that want to start or grow. And then we do have some term flexibility that I'll talk about in a moment. But in order to be qualified or eligible, you do have to meet some basic criteria. You do need to be small. Now, for most of you, what small may mean is one of two things. We have something called an alternative size standard, which is 15 million in net assets, 5 million in net income, averaged over the past 2 years. If you are below that, you are small. Or it can be done based on your NAICS code, your North American Industry Classification Code. Within that code, we have another size standard that could be based on revenue or number of employees. And if you don't meet the size standard that's called alternative, then you can go to the NAICS code on SBA.gov and you can look and see what your standard is. And sometimes it's employee-based and sometimes it's revenue-based. The type of business also has eligibility criteria that I'll talk to you about in a moment. What you're doing with the money, and also you do have to be a for-profit business. Nonprofit organizations are not eligible for the SBA guaranteed program, but the process and the criteria are very similar to how you would go get a loan and what we've just talked about. So by watching this presentation, although the SBA guaranteed loan program wouldn't be an option, everything that we're talking about would be applicable in terms of the preparation. You also do need to meet the individual lender's credit requirements to start with. So to give you an idea, some things that are, not eligible, most run-of-the-mill businesses are eligible. Here's just to give you an idea of some things that wouldn't be. Religious teaching, sexual materials, speculation, gambling, incarcerated on probation or parole, you can be eligible. You have to follow a process. Nonprofits, we mentioned that. Lenders, passive owned real estate, that's something that people get confused by. But what we're saying by passive owned real estate is real estate that you're buying to rent out, that you're not going to occupy. You're literally buying a strip mall so that you can lease it out, or you're buying an apartment building, or you're doing things of that nature where you're not actually going to be running a business on the property. You're just buying the property to flip it or to rent it. Obviously, foreign businesses, pyramids, and if you defaulted on a federal loan resulting in a loss, you may not be eligible. There are different circumstances for different people, but basically what it means is once bitten, twice shy. If you have defaulted on a loan and caused a loss on another government guaranteed loan program, your name may go into a database, and then you may have to work out some sort of arrangement with that agency if you do have a default. And the lenders are generally pretty well aware of this and can probably guide you through if you do have a scenario where you have, defaulted on a loan. When we talk about what you can do with the money, just to give you an idea, we talked about working capital, inventory, machinery and equipment, land and building, that's purchase and construction, debt refinancing, so existing commercial debt that qualifies, you may be able to use that, and change of ownership, which is buying a business. Those things you can do with the SBA loan program. What are ineligible? Real estate held for investment, that's what we were just talking about, purchasing a portion of a business. So that means buying into a business, not buying the whole thing, and that would be speculative and an investment. It is not eligible. Payment to principals, which means returning money to the owners that had previously injected it. That is also not eligible. In delinquent payroll taxes, just to give you an idea. When I talked about the flexibility of maturities, generally we have longer maturities than what a typical commercial loan would allow. When we are financing working capital, it's up to 10 years. In machinery and equipment, depends on the useful life of that equipment, but it can be up to 25 years. And if you're doing multiple things, you're buying property, you're doing a business purchase, it can be up to 25 years as long as the largest asset in that package, that financing package, is real estate, then you can finance the whole thing on a 25-year note. And if you wanted to, for example, if you had some working capital and you were buying real estate, you could combine it all in one loan, or you could keep them separate and finance the working capital over a shorter term because your preference is to pay it off. That is also possible. So there are some flexibilities within those legislated benefits. Now let's talk about interest rates. It's very important that you understand that this is negotiated with the lender, but we have caps on them. And it is generally 3% over the prime rate. The current rates are going to be anywhere for commercial loans, prime plus 1 to 3. For those of you that follow prime, you realize that it's been being bumped up every couple months for the last year, and that it's now at 6.25. You can negotiate your interest rate with your lender. In order for you to do that, you're going to need to have some strengths in those credit profiles that I had mentioned earlier. But we don't dictate what the rate is. All we do is place a cap on it. And it's important that you know that, so that as a consumer, you have the flexibility to shop lenders. Also, just this bullet point of understand the lending contract before you sign. What I'm talking about here is making sure that you really do understand your terms, making sure that you understand if you signed a variable note, when does it change? Are there caps on how much it could go up or down? All of these things are very important for you to manage the finances of your business. So before you sign on that dotted line, make sure you understand your lending contract. It is very important that you have a really good idea what could happen, as a lot of small businesses today are finding when they signed up for a variable rate note that the next time that that note is going to adjust, it's going to go up because it is based upon prime plus a margin. And knowing that can help you prepare for it. So it's very important that you do understand that lending contract before you sign. And if you don't understand a lending contract, that's where you might want to reach out to neutral third-party advisors who are familiar with these lending contracts and can assist you with understanding what does it mean when it says that it's going to be quarterly variable after the third year, and what is the margin and what is the current base rate and how would that work. Those types of things need to be kind of scenarioed for you to have a full understanding of the lending arrangement that you sign and agree to with the lender. We do have costs and fees when it's a lot like other government guaranteed loan programs. If you've ever used them, it is subsidized by the user. So we do have a guarantee fee. It is anywhere from 2 to 3.75% of the guaranteed portion of the loan amount. In parentheses, I have less than 500,000 is waived through 9/30/23. So this year there are no government guarantee fees on SBA loans that are less than 500,000. That does change year to year. Last year it was 350. This year it's 500. Prepayment penalty can be applicable to longer term loans. Anything that's over 15 years in a term can have a prepayment penalty. You're going to want to make sure, like understanding your lending contract, that if there is a prepayment penalty, that you do understand exactly how it would be applied to your loan. But bank fees, things like origination, commitment, paying a broker, commissions, referral fees, they are not allowed. The lender can charge you servicing or packaging fees, and late payments can be allowed. For example, if you don't make your payment by the 15th, they can charge you for that. Expect to provide information when you apply. It will be very similar to a mortgage. It's going to be business and personal. How much of it, how long the loan takes to underwrite and get approved is largely up to the lender, but it can take just a couple of weeks to many months for construction projects. If you need to know exactly how long it's going to take, then you need to make the lender you're working with accountable for their time frame and to provide you with timely updates on the status of your loan application. This is just a quick checklist. Your lender should provide you with the exact checklist, but these are the things that you can typically expect. So these are things like tax returns, collateral documents, any business agreements, if you're refinancing, notes, your business plan, and potentially a few SBA specific forms. But again, your lender will give you your exact checklist. So which lender should you consider? We talked a little bit about finding lenders. You're going to want to consider your existing banking relationship if they meet your lending needs and participate with SBA. We always recommend you start with your existing lender. You're going to, if you're a startup, you're going to want to look for lenders that actually lend to startups. And one of the documents that we've made available to you is called the Lender Master Record, which is a list of voluntary participant lenders that have told us what their credit preferences are. Not every lender is required to lend to startups. They get to choose that on their own. So not all of them do that. And so if you didn't know that and you start just walking into bank branches and saying, hey, I'm a startup, I want a loan, they may not actually lend to startups. And you might walk into 3 of them in a row and decide that nobody lends to startups when that's not true at all. It's just you need to prepare and you need to look for lenders that do startup lending. So lenders do have preferences. Some of them have loan size preferences. They don't really want to do too many loans that are less than $100,000 because it costs them quite a bit to do that. So you do need to look for a lender that fits your scenario. And you can use Lender Match, as I mentioned, and you can also use the document that will be made available to you after the presentation. Don't accept any loan if it doesn't meet your need or you do not understand the terms. So we talked about being prepared. We talked about seeing the right person at the bank, making sure that you're seeing somebody who who has SBA experience or is the business banker for that institution, having a well-prepared loan proposal and business plan, that's going to be very critical. When we talk about the 7A loan program, I wanted to just briefly touch on microlending. Microlending are smaller loans. They're not guaranteed. They're provided by different types of lenders. They're more community-based, usually CDFIs. They have a little bit more flexibility with their credit profile than your federally regulated lender does. Most of the loans are $3,000 to $7,000. It can be a great source if you just need $5,000 to get started, or your credit isn't perfect, you got little or no collateral. There are some, borrowing scenarios that fit this microlending bill much better than trying to get a $7,000 loan with one of the big banks. They are also listed on that document that I mentioned. The 504 program, for any of you that are interested in purchasing a large fixed asset or commercial real estate, this is a more complex loan program. And what I would tell you there is that the lenders that provide the 504 portion are on that master record that I mentioned earlier. You would want to contact them and have them walk you through what the terms would look like, because it is a participation program, very different from 7A, where they get a commercial lender to provide the first mortgage. Usually it's 50% of the project, and then the 504 loan covers the remainder, which can be up to 40%. But you do have two loans, you do have two terms, and that can be a little bit complex. And so it makes sense for you to contact them if you're looking to either build commercial property or refinance commercial property or purchase commercial property. Now, when we talk about getting additional help, we say the parts of a successful SBA loan are the borrower, the bank, SBA as the guarantee, and the small business counselor. So let's talk a little bit about resource partners. And Robert had mentioned this a little bit earlier, but we have organizations that we partially fund that will meet with you one-on-one and provide technical assistance. So for example, SCORE, Small Business Development Centers, Women's Business Centers, Veterans Business Outreach Centers, our microlenders and our lenders are all resource partners. We have a document, which is our Arizona resource guide, that will be provided to you at the end, that lists all of these organizations, where they're located, what their phone numbers are, all that stuff. And then I wanted to touch on other resource partners like the Arizona Commerce Authority. They're aligned organizations that have a host of programs that may be a little bit different than what I'm talking to you about, as well as libraries, chambers of commerce. Some universities host incubators, community colleges as well. And then state and local governments, including Arizona Commerce Authority, have other very unique programs that may be of tremendous value to you. And just as an example, whether they're pitch competitions or whether they are incentives, community incentives to start and grow business in one of the, the cities, for example, like the city of Tempe or Gilbert or Tempe, sometimes they can have incentives, for small businesses to start there. They want you to hire your people from there. They want you to pay taxes there. They want you to be located there. So if you're starting a business or you have an existing business and you've never looked at this, it can make sense for you to reach out to your local community and find out what kind of incentives they have. Maybe they're tax incentives, maybe they're hiring incentives, things of that nature. But you'd have to find that by rolling up your sleeves and reaching out to those community points. There is all kinds of free training on SBA.gov. If you go to SBA.gov in the training section, it's called the Learning Center. There is tons of stuff on there, how to write a business plan, a little bit more about financing options, things of that nature that's free for you to use. And to reach any of our resource partners, that bottom link right there that says Get Local Assistance is on SBA.gov. And that's how you can type in your zip code, and it will literally just give you all of those resource partners that I mentioned with all of their contact information. So that can be very helpful. And you can also reach our office with any questions through the phone number or going to the website as well. Now I'll leave you all with this. And I know you can't, because I think you're all muted. I know you can't blurt this out, but I would say, what do these businesses have in common? And almost every presentation I've ever done, somebody's guessed it. You recognize these as global brands, right? These businesses all started small, and they all had some sort of SBA interaction when they started. And when you look at this list, I know some of them have turned into movies. Some of them, their story, they've been, they're global brands at this point. So that same opportunity exists for every one of you that's present today. And I'm hoping that you've got the three things that I mentioned out of today, which is you have a better idea what SBA is and does. The most important thing is you know where your strengths and weaknesses are in your credit profile. And then the third thing is you have an idea what your next step is. You should have an idea whether you're going to go ahead and kick around a business plan and get started on it, or whether you really feel like you're ready to go ahead and, approach a lender. You're in business for yourself, but you're not by yourself. So we appreciate you taking the time to learn a little bit about that capital. And I'm going to stop sharing, Robert, so that you can open it up if you want for questions. And we might even talk a little bit about the interest rate environment.
Yeah, so we have a few questions in the Q&A box. We'll go through those real quick, and we have a few minutes to try to answer those.
Sure.
If we can't get through these, we'll send them over to Craig, and he can reach out to you afterwards. But it says, does the SBA use and pull business credit report, or do you use the personal credit scores?
The lender would do that, but both. So for some businesses, especially when you're starting, you don't have business credit yet. And then for some businesses, you have tons of business credit. If there is business credit, your lender will pull it. Depending upon the age of the business, it might weigh heavily or it might weigh none at all. But for sure, your personal. And then if there's a significant amount of business credit, they will look at that as well.
All right. And then we have, what are the unsecured options available through or with the SBA?
So the only real unsecured options are going to be based on loan size. So if it's less than $50,000, it is not required to be secured. If it is more than that, then the lender is required to look at the personal assets of the business. If there are no personal assets, it again doesn't mean you can't get a loan for more than $50,000. It just means that the lender is going to need to make a credit decision. And generally that's going to be made on strengths in other areas.
And then we had another good one. It says, would intellectual property development costs count as investment we make towards an equity investment?
It can, as long as it's aligned with what the product or service is that you're going to sell. So yes, if it's research and development for a side project, it wouldn't count. But if it's specific to what you're going to be selling, then it can count as injection because it is a startup cost.
Okay, we got one last question, and this is a great question to end on. It says, should we have attorneys review the loan terms in addition to the resources shown on the slide?
So that's up to you if you want to pay for it, right? Because that to me means you're going to end up paying for it. But what I would tell you is that if you're not sure and you're comfortable with engaging, your attorney to pay for it, then that's fine. But you do have free resources that can help you understand that by using the resource partners, but that would be completely up to you. My general advice would be just get somebody who knows how to read a note and loan term agreement and explain it to you so you understand it, whether you pay for it or whether you don't.
All right. Excellent webinar. Thank you, Craig, for your time. Great information. As Craig mentioned, there's some additional documents that will be available on the bootcamp website under this recording. We'll make the slide deck available along with those additional documents, the lender list and so forth. So you can go there to find that a little bit later today. Again, thank you, Craig, for the presentation. Thank you for those great questions that we had. And again, Craig's information on how to contact him is the SBA district office. That will be on the slide deck when we get that posted up. But if you have any other questions or need to get a hold of me, you can also reach out to myself or Faith. We can get you connected with the SBA or any of those other organizations that were mentioned. So with that, we will go ahead and wrap up. Again, we appreciate the SBA and their time to be with us. And we look forward to seeing everybody next Tuesday morning at 9 a.m. And until then, have a great week.